Under fixed asset, it can also be classified into tangible assets. What are tangible assets? These are assets that can be seen or touched, such as land, machinery, equipment. So it's an element of fixed asset. Like tangible is something that you can see. But intangible assets, these are assets which have no physical substance or property, but contribute to the economic benefit of an organization. So we have goodwill, copyright, patent, and trademark. Like goodwill is something that is attached to business. And the number of goodwill is when company was 6,000 and you sell this for 7,000 naira. So it has goodwill of what? 100 naira. It's a purchase consideration of a business. And what are the things that can contribute to goodwill is good management, then profit and loss. Their profit that they make at the end of the year can constitute a goodwill for a business. So it's an intangible asset, but it's also company benefit from it. The copyright, it is for those people that are producing papers, textbooks, and all those things. They have copyright, at which you see at the front page of the book that nobody has the right to produce that book except the owner of the book. Okay, we have patent rights, trademarks. This goes for those people that are making a product. So they have a kind of trademark which has this mark. In advance company has been registered and it begins to trade, then it has a kind of a patent right which nobody has right to produce that goods again except that particular company. There are that similar goods. So there are some similar goods that perform the same thing, but it is quite different from when the company has the patent. That means nobody can produce exactly that product that they are producing. So trademark, so they are an intangible asset of the company. Then we have liquid assets. These are assets which can easily convert into cash. E.g., we have security like investment. Investment is a liquid cash at which you can easily dispose it, and we can also call it shares. Shares is a liquid asset. You know, when the company has shares in a particular company, is a liquid asset. Now, what are current assets? Current assets, these are assets which are usually held for a short period of time for a purpose of conversion in the ordinary course of a business. We have cash, we have debtors, we have a bank and a stock. And the reason why current asset is different from the fixed asset is that when company need cash at the end of the year, they need a quick cash. They can easily convert current assets into cash easily. But it is not easy to convert fixed assets into cash because of the huge amount it entails. Like asset that was 500 million, you can't get it. You can't dispose it within a short period of time. It can take a long period of time. So current assets are the assets that you can easily get, like cash. If the company need the asset, they are short of liquidity. So liquid, and they want to make some payment, then they can easily get through with their cash in the bank, or they can easily sell some stock to get cash at the end of the day. So that's what we call current asset. Then likewise we have a liability. Liability are the obligations arise from the past transaction. Liability, when we call something obligation, is that there are some people that they have obligations to pay. You know, when you make loans, when you have debentures, you pay those people that you are owing at the end of the day. So it is a obligation that has arisen from the past transaction that you have made during the year, or you have made in the previous year. So then we have type of liability. We have long-term liability. Long-term liability, they are liability that you can settle for a long. It's liability that take very long period of time. Like when you take a loan that will last for good 50 years, you can classify it under long-term liability. Why? E.g., you can call it debenture or bonds. Bonds is used by the government in order to source for money, and then before a bond can mature, it takes a long period of time. And debenture is also another form of loan which can take many years before the company repay the liability. So that's what we call long-time liability. Then likewise, we have current liability. These are liability which due for settlement within a year. And that's why in the financial statement you see those things, they are classified in the balance sheet. So current liability, these are the liability that like when you get a loan that you have to pay it within a year. So it is classified under current liability. That's why we have creditors, we have overdraft, we have accrued expenses. Anything that you accrued or outstanding, they call it you can call it also owing and the like. So they are classified under current liability. Then here, that takes us to capital. What is capital? Capital is the original money invested in the business by the owner. As we know that without capital in the business, then it is impossible for you to start a business, because that is the main thing that will keep this business going at the end of the day. So it's the money that you invest in the business at the end of the day. So now, here we go to format of balance sheet. Balance sheet can be prepared in two aspects. It can be prepared in T format. This is the T format form, and you can prepare it in the horizontal vertical format. But in practice, you might find yourself working in an audit firm or accounting department of an organization. Accountant is expected to prepare any method, any account in the vertical format. But for a secondary level, you are always familiar with that of T format. Now, these are the format of balance sheet. You can see we have fixed assets, those are we have mentioned earlier. We have current liability side, and then there's something I want you to know about balance sheet is that it is not attached with a document principle. Is a statement, is not an account. But on the left side, on the right side, we have a liability claim side. On the left side, we have asset claim side. So these are the format for the balance sheet. So having seen the balance sheet, we go to the illustration. Below is the trial balance of Olonto as 31st December 2000. Trial balance is drawn where the items are being put under the side where they belong to. These are the questions, and then we have another information. You know, I said earlier that any information given in additional information must be treated twice. That means it will appear in trade profit and loss. Likewise, it will also appear in balance sheet. Now, we are told to prepare the trading profit and loss account as at 31st December 2011. But before you go to the question and start preparing your account, you first do justice to additional information, because you must do what we call workings. And that is very important when you are given. It also attracts marks during the exam, so that they will know whether you know this or not. While preparing your workings, it will be able to help you to post all those entries and make sure that the accuracy is okay. So we take it one after the other before preparing the main account, which is the trading profit and the balance sheet as a third date. Now, we have provision A, provide 20% for discount on debtors and create a bad debt provision of 10%. So here, what you are going to do is that, what is our debtor? This is our debtor. Our debtor is, let's look at the question. Our debtor is 6080. And don't forget, under the additional information, F said write off bad debt of 1,000. So you said less bad debt. You less bad debt over 1,000. That gives you 5080. So remember that this one is going to P&L. That means this bad debt will appear in balance sheet and will also appear in the expenses in the profit and loss account. So it has to be treated twice. But because out of the debtor, 1,000 bad debt is not likely to be received at the end of the day, and that's why we have been told that it should be written off. So bad debt is quite different from provision. Bad debt is you write bad debt off, but provision is also an expenses, but there is a possibility or doubt that you are going to collect it or not. Now, you now less. Remember, we are given provision of 10%. So provision for debt, that is how much is that? Is 10%. So you use the remaining 508, 10% of 508, that will give you 508. So you less it from the remaining balance here, because the provision you have to make is 508. So this one is going to P&L and is also going to balance sheet. Now let's add it. That is 4572. Now after that, remember that another provision, another discount on debtor. All the discount, if it is given as of information, they relate to debtor, bad debt, provision for bad debt, and discount on debtor. They relate to debtor. That is the reason why we are adjusting for it in this working. So less provision for discount, and what percent is our discount? We have 20%. So 20% on 4572. So that is 914. So if you add it, this is 35658. So this is the remaining debtors that is going to the balance sheet at the end of the day. So this is the remaining debtor. Having written off bad debt from that debtor, their provisions, likewise for a provision from that remaining debtor, their provision for discount from that, the remaining debtor that your customer is owing you is 368. So that one has been adjusted. Then B, we have depreciation of 5% is to be written off on the plant and depreciation and the furniture.